it's Nancy from Nancy True Homes, and I wanted to talk to you guys today a little bit about some of the disconnect that we're seeing in the media regarding the economy versus the opinions of people in mortgage and in real estate. So I'm going to backtrack a little bit and I'm going to sort of start with so there are currently in the past like 18 months or so, we've seen over 100 merger and acquisition deals for small lenders. Okay. And by small lenders, we tend to be talking about lenders that maybe do 1 billion or so a year of volume. Okay. So this is not going to include, Rocket Mortgage, Loan Depot guaranteed rate. These are much larger independent mortgage banks. And they seem to be, capable of weathering the storm just given their size. But a lot of the small mom and pop shops you're seeing beaten, eaten up by, larger organizations. Now let's talk about why this is. Right now, Fannie and Freddie are eating up as much as they can on the secondary market. I haven't figured out if it's because they're concerned about, these IMBs and potential future insolvency, or if, they're just greedy for mortgage-backed securities. I don't know, but they're just eating it up. And if you as a client go get a mortgage, there's a really strong likelihood that all the rules that you have to follow to get your mortgage is going to be compliance that Fannie Mae and Freddie Mac want in order to purchase your loans on the secondary market. Does that make sense? So in other words, your primary lender is really following a set of compliance rules that will allow them to sell the loan to Fannie or Freddie on the secondary market, right? Now, I'm going to tell you right now, if you are suffering from, or if your lender is in a situation where they are not in compliance and Fannie and Freddie are not interested in them, then that's sort of a red flag, right? It's a red flag that you guys have compliance issues, or you have maybe this lender has products that kind of don't really fit into that, compliance picture for resale. Now, if that's the case, if Fannie and Freddie cut you off, then that could be a potential problem, because how you get money to fund new loans, a lot of it is based off of being able to sell the current loans you have on the secondary market. And another way in which you get money that you've probably heard me talking about is warehouse lending, right? So small, mid-sized regional banks are huge warehouse lenders to help you with a line of credit so that you, lender, can go ahead and make more new loans. Well, if Fannie and Freddie cut you off, there's a really strong likelihood that the warehouse lenders are going to cut you off too, because they're thinking, well, if Fannie and Freddie don't want to touch them, then why should we, right? So if you're a small outfit and you do a lot of, non-compliant loans, you could be in a bit of trouble right now. Are you able to maintain a slush fund of 2.5 million? Because these are some of the things that are required in order to sell off to Fannie and Freddie. So what are you left with? You have to sell off your loans at a discount, which probably means less money coming in to make new loans, or it just means that you're holding on to it. And also no new coming in to make new loans. And at that point, without warehouse lending lines of credit, you're probably in a little bit of trouble. Okay. So how does all of this kind of comport, right? This is some scary stuff. And it sort of tinges how lenders feel about the economy as a whole. So listen, there's places you can get your news. And if you're getting your news from CNBC, Bloomberg, if you're getting your news from business sources, what you're probably seeing is that the economy is not in terrible shape. While, affordability is not great, and unfortunately, inflation is still high, but the CPI numbers have indicated that the rate of inflation growth has slowed significantly, that what the Fed is doing is actually working. Okay. We're hearing things about no recession, soft landing, right? The jobs report is very healthy. People are buying and selling. They're buying and selling luxury goods. They're going on vacation. The overall economic picture is not a terrible one. So why do 73% of lenders, when polled, feel that the economy is going in the wrong direction, right? What about 93% of lenders feel that we could be headed towards a recession in Q3 and Q4 of 2023? Why does this not comport with what we're seeing on, listen, if you go to YouTube and you're watching, random YouTube videos, yeah, it's clickbait and they're going to tell you the sky is falling. But mainstream news has not really indicated that. The Fed has been pretty clear at this point that they were talking about a 25 basis point jump in July, a 25 basis point bump maybe in like September, but that's kind of it. They're telegraphing that after that, they might just choose to stay the course, right? Which means that if they stay the course, then we're probably looking at a year or so of the current interest rate staying relatively stable, which is probably between 6.5% and 7%, right? And then we're not looking at any potential reductions until probably, Q3 of 2024, right? But really, the truth is, at least for our market, the buyers haven't stopped. People are still receiving multiple offers on their homes. I would tell you that right now, for a lot of buyers, it's less about the interest rate and more just about the volatility and how, this constant of the rate, that is what causes uncertainty. But when the rates kind of stay still for a little bit, we can't really stop buyers from graduating, getting a job, getting married, having babies, wanting to purchase property of their own. So if we have a situation where the volatility just stops and we see the rates kind of stay still for a period of time, I'm going to tell you right now that the buyers are going to be out in droves, and therefore, hopefully, more sellers will be willing to list their homes as well, okay? We're just looking for the new normal, and the new normal is it's okay if it's between 6.5 and 7. It just can't move that much. It just has to stop, okay? But what's interesting is why are lenders continuing to say things like the sky is falling? Why do real estate agents continue to reinforce the idea that the sky is falling? Well, because lenders, unfortunately, right? You're seeing a lot of that negativity in the lender side because the lenders are boots on the ground. And yeah, we are seeing, a lot of behind closed curtains, mergers and acquisitions, small outfits being eaten up. And even some shutdown deals, right? So in other words, we haven't seen shutdown deals in a long time. Shutdown deals, that means that you couldn't get anybody to buy you. You either waited too long or your situation is so bad that nobody wants to buy you. And then we just have to work to shut you down as a lender. And I think that kind of activity, which we do know is increased, is giving that, shall we say, that negative feeling that comes off of lenders. Now, when lenders create these sort of negative outputs, right, in terms of feelings, then agents will pick that up. Real estate agents also pick that up, and they perpetuate the negativity. And you guys are the first line of defense to consumers, I have to tell you, which means that if you project the negativity, then the consumers do as well. The consumers will feel that, and they will draw their conclusions, and you'll see them pull back. But the truth is, the economic news is not that bad, you guys. We're talking soft landing here, going into Q3 and Q4 of 2023. That's good news. It means it worked. It means the Fed did what they did with success. And we're at a place now where hopefully we can just glide on into the runway, land on our belly. We're going to be a little scuffed up, but we're going to be alive and we're going to be healthy. All right? So what's the question? The question is stability, less volatility, right? You got to figure out how to understand how to counteract the question of uncertainty. And I'm going to tell you right now that purchasing a home with a 30-year mortgage, which, by the way, is the biggest security hedge for the middle class in America. You have to understand this. Let's talk about this. You're afraid of volatility, you're afraid of uncertainty, then buy a darn house. Because if you buy a house, then for the next 30 years, Or even if you buy an ARM, you use it with an ARM, an adjustable rate mortgage for the next 7 years, it means that you're locking in your shelter cost of living for the next 30 years if it's a 30-year conventional, 15 if it's a 15-year conventional, 7 if it's a 7-year ARM. That's the most certainty you can get, as opposed to the uncertainty of the world of, is my rent going to go up, right? What's this interest rate going to look like? You know what? Lock it in. Lock it in so that number stops moving. And then over time, over the next 2 years, find the time when the rate does finally drop to a degree where you can refi into a smaller payment. And if you, like I think most Americans are, if you are growing, right, in your work, if you have future earning potential coming down the pike, future raises coming down the pipe, well, then guess what? That's great. You've locked in your rate by purchasing a home. You've locked in and you've done away with that uncertainty for your cost of living. All right. Just a little something for you to think about. Put in your pipe, smoke it. And of course, as always, feel free to comment, like, and subscribe. And if you have any questions at all, you can always reach me, 917-992-3098. All right, guys. Talk to you next week.